Welcome everyone to our webinar today, how to successfully value an SME with Steve Shaw and Valutico. Steve, welcome. Thank you very much for joining us once again. Always great to have you on the show.
Always a pleasure.
Very good. And I'm also joined today by Greg Brown, our director for the UK and Ireland, country manager, also in charge of EMEA. Typical understatement, you didn't even put that on the slide, Greg. Welcome.
Thank you very much, Paul. Very warm welcome to everybody attending.
Great. And myself, Paul Resch, CEO and co-founder here at Valutico, background in valuations and corporate finance. I started my career in mergers and acquisitions. That's where I learned the valuation, the valuation trade. Steve, more on you. I hand over to you. I think you can introduce yourself.
Okay, well, I'm basically a trainer, but I also do a lot of valuation work in a specific area of options in Monte Carlo, especially with share options. And I've been, taught these courses around the country, but originally I was an audit partner. So I come at it from financial reporting originally, and then realized that there were lots of other things you could do with valuation apart from financial reporting. So I'm always happy to join you on Valutico, and look forward to a really good session.
Thank you, Steve. And also the man, by the way, who trains the Valutico team or across sales and customer success and product. So a lot of our ideas we also get from Steve. Thank you for being with us today. Yeah, maybe what do we have planned for today? First of all, a very quick introduction to what we do here at Valutico. And then we talk about the specifics and pitfalls of doing SME valuations and what to look out for when you do that. Valutico is an integrated one-stop shop for everything around valuations. If you think about it as something that can, replace your spreadsheets, replace maybe one or the other database that you pay for, and maybe even replace, half a junior staff member when it comes to preparing, financial statements and stuff like that. So, yeah, we give you access to all these databases. We connect to many of the world's leading databases when it comes to valuations. Advantages, you only pay for the stuff that you actually need, right? Not the 99% of all other financial data that you will never use. We automate certain sub processes when it comes to valuation work, so we save you a lot of time, big efficiency gains. Conservatively, we say we save you roughly 50% of the time for a typical valuation. What we typically hear from clients is that we reduce the time that it takes to do a valuation from a few days to just a few hours in most cases. And then, another big benefit or USP of what we do is that we also provide you support from valuation specialists. We employ in-house experts who can, lend you a second pair of eyes when it comes to reviewing valuations that you're doing. Let's say, I don't know, your team members are on holidays. You don't have anyone, if you're a single solo practitioner, to review your work. We can do that for you, but we can also do, entire projects for you if you are too busy, for example. 3 terabytes of financial data, over 50,000 listed peers on the platform, and close to 1 million transaction multiples and counting. So we are continuing to add more and more to our growing database here of transaction multiples. A quick overview of where we're active. We have around 650 clients in about 85 countries. So you see we're active in most of the Western world. Increasingly, also, by the way, on the Southern Hemisphere, a very strong footprint, also in Asia Pacific, for example, which already accounts for close to 20% of our revenue. And it's not just our clients who are all around the world, but it's also our team. So we have actually closer to 70 team members globally at the moment in 24 countries. So you can be sure that, when you work with Valutico, you will be working with people who speak your language and who understand your local requirements when it comes to valuations. Maybe another highlight, we speak 28 languages. I'm not sure how we're tracking that. Maybe we're including dialects in this, but it's something that always amazes me when I read that number. Quick overview. Greg, maybe you want to add a few words here, since this is mostly about our UK clients. Maybe
Go
ahead.
Thank you very much, Paul. So this is just a very, very small selection of Valutico's clients in the UK. I joined the firm 4 years ago. We built a business up from scratch. So we've closed many of the top 100 accountancy firms. Very proud of that. And of course, as Paul's already mentioned, we've got quite a significant international client portfolio as well. Thanks, Paul.
In terms of the top networks globally, we're very proud that we work with over half of the top 20 networks already, and we're actually also growing very quickly within these networks. Even they have access to a lot of people and data and everything else. What they really appreciate is that we also harmonize valuation standards across different teams, right, and different people, and we can help with quality assurance also, right. Right, so much about Valutico. One more thing. There's always one more thing. Apologies for that. We also launched Valutico this year. This is our ESG module for those of you also active in ESG. What this does is basically it's an ESG questionnaire that is specifically built for SMEs. Right, since you're all here, because I guess you're interested in SMEs specifically. This is built for SMEs. SMEs cannot fill out, I don't know, a 1,500-page ESG survey that other providers usually require. But increasingly, also SMEs have to have an ESG score, right? When it comes to government grants, when it comes to loans from commercial banks, increasingly they will require ESG scores. So we built this for SMEs. You might wonder, what's the connection to valuation? What we do is basically we translate the ESG score into an adjustment to your cost of capital. Right, we found that there is a connection between a company's riskiness as measured by the volatility of its cash flows and the beta factors, and ESG factors. We're not the only ones who found that link, but we're the first ones who built a framework to connect those two concepts. Good. That brings me to the agenda for today's session, just in time. Steve and I will have a little discussion about SME valuations in particular, and then Greg will take us through a quick case study where we're doing a valuation of, I think, a software company in the UK, and then finally we'll have some time also to answer your questions. As usual on these Zoom webinars, feel free to ask questions also during the webinar. We'll try to answer them either during the webinar or during the Q&A session in the end. Okay, Greg, Steve, anything I forgot to mention?
No.
I think very surely we're going to also have a poll, launch a poll as well. Yeah.
Oh yeah, I think we're actually kicking it off with a poll. What's the biggest issue when you face the biggest issue you face when valuing SMEs? So you should see a poll question now. Are we allowed to answer that as the panelists?
No, we can't. By the looks of things.
No, I can't. Same here. I've been trying to click. It doesn't work. Okay, let's see. We'll give everyone a minute to answer that. Biggest issues when valuing SMEs? Is it understanding and applying appropriate valuation methodologies? Always an issue. Accessing the correct data. Well, that's I think a general topic with valuations. Peer selection. I'm sure Greg will show us some tricks today. Issues with clients. That's an interesting one. I wonder if how many people will click that. Normalizing financial reporting. That's always a big one, right? With SMEs, I think we'll actually dedicate some time to that today, and understanding the industry. Question to Alex: do we already have enough answers to close the poll? Okay, so let's see. We have a result. What do you think, gents? Surprised there?
No, not at all, actually. No, I think accessing the correct data and peer selection are two which certainly come at the top of my list.
Yeah. I mean, peer selection in particular, right? You have a small company, and and then you come up with a peer group, maybe even listed peers, right? That always needs some explaining, right, with the client. at least in my practical experience, right? How am I comparable to whatever this global corporation, right? And accessing to correct data, yeah, I think that's definitely something we as a company here can help with. Yeah. Okay, so with that in mind, maybe let's jump into the topics, and maybe we can give some tips and ask the right questions on the next couple of slides. Well, Steve, I mean, why do we even need a valuation for SMEs?
It's a good point. There are, in some ways, not, but in other ways, there are a lot of different reasons which all will give rise to different questions and different answers. And you'll see here that obviously the transaction, this is where I get involved mostly, actually, is actually helping with transaction analysis, but also due diligence and also negotiating input. I don't tend to issue many reports on SMEs because in a negotiating situation, they're looking for the drivers, and each one is different. Financial reporting, of course, under IFRS, certainly IFRS 3 and IAS 36. Tax authorities very used to it, and forensic, again, very useful because a lot of these situations are to do with loss of profits, but also divorce situations and changes in ownership. But one thing I don't get involved with very much is fair value for SMEs. You might need it for impairment testing, but I often ask myself, well, why would someone want a fair value report on an SME? Mm. Unless it's to show around the banks, perhaps like Donald Trump, for example. So as a professional, that's the sort of thing I would stay away from, to be honest. Mm-hmm.
Mm-hmm. So there can be, I guess, many different types of value, right, and very different results, right, depending on the situation at hand, I guess, right, and the
absolutely. For example, you're often looking at different investment values, and you know that every person or every party or every stakeholder will have a different investment value. And the problem with fair value is you're looking for this market participant who's knowledgeable, independent, willing, and able. But in a small company, there may be 3 or 4 different people, none of whom coalesce around what's called a market participant. There might be a trade buyer, there might be another family involved, it might be a forensic situation, might be a tax-driven one, or there might be a private equity house, all of whom are asking totally different questions.
Yeah.
Which is why it's quite difficult to get an idea of a fair value, from whose point of view. There is no sort of coalescing market participants that you find in, for larger companies, for example.
Yeah. I mean, you mentioned the topic of family. I think that's something we'll actually have a closer look later on also, right?
Yeah.
La Familia.
La Familia. Yeah, we'll leave that one to you, Paul, a little bit later. Yeah.
Okay. Very good. Well, let's talk a little bit about also the discrepancy between the theoretical discussion and the practice, right? When we, value larger companies, right? Things are easier, right? Many of the assumptions, for example, of the capital asset pricing model hold, right? You have from the perspective of an investor in a public company, you have a well-diversified investment portfolio, right? The sort of firm-specific risk is diversified away, right? And that's why CAPM works, right? You have not these principal agent topics, right? Independent management and so on, right? And most importantly, you don't have anybody who's got the whole capital tied up in the company, and that brings me back to that diversification point, right? So CAPM is great. It's a great theory, right? We use it a lot, but it simply doesn't hold, right, for companies that are private in many situations, right? And that's just.
You also have to say that the CAPM, even in the US, has only got a 35% R squared, so it's not that strong. And remember, that the CAPM was designed really for portfolio management. It wasn't designed to value a company. Yeah. So we're always making, even with larger companies, we're always making compromises in any case.
Yeah. I mean, I come from sort of the German-speaking valuation world, right? Where, the CAPM is holy, right? Something like
yes, yes.
a firm-specific risk premium is a big sin, right? Is something that's definitely not allowed. But I mean, when you look beyond the borders of Germany, Austria, it's very much practice, right? I mean, if you do a valuation in the US of a private company and there's no whatever size premium or whatever you want to use it, that valuation will probably not hold, right? Somebody
Well,
will dispute that.
let me defend the Austrian, Swiss, German thing. Obviously, the Institute of Wirtschaftsprüf, as the IDW, basically says, look, we shouldn't have alphas. But actually, what I find in Germany and Austria is that people are quite, I'll use the word funky, but quite sort of imaginative about how they use the beta information.
Yeah.
And
you can do with the beta whatever you want.
Exactly, and that's using an alpha under any other term here.
Yeah.
I would like just to say that the owners have their whole capital tied up in the company, and in the US, some of you may have heard of this movement with Butler and Pinkerton called total beta, where they start actually saying, well, you should divide the beta by the square root of R squared, which is rho. But actually, that's probably more directed towards this what's called a fundamental discount, is that there are no mean variance investors. And I'm not being mean, like not nice. I mean, mean variance investor, which the capital asset pricing model and the strong market theory suggests. So the owners actually have much more, as I say, that they probably want a higher return purely because they've got all their eggs in one basket.
Yeah, that makes a lot of sense. And so at the total beta, how does it help with that?
Well, it's a mechanism where you actually take the ordinary least squares beta and you divide it by the square root of the R squared, which is R, and that gives you a higher beta, and that's supposed to give you a small firm alpha, if you like.
Okay.
But I don't necessarily go with it because I don't think it's measuring that. I think it's actually measuring what Damodaran calls the fundamental discount, which is having your whole capital tied up in the company.
By the way, a little side note. So at the moment, what Valutico does is obviously we derive the beta from a peer group of public companies, but you can make adjustments to that beta if you want. We also have a module which we call the qualitative assessment, which makes a suggestion for an alpha. Right? Essentially, we call it the cost of equity premium. But you are free to play around. Override the one, set the 1 to 0, use the other. So we give you all the options to override what the system suggests.
Yeah, that's my favorite part of Valutico. Is it's the questions that you ask are so important. And if you're looking at alphas, it's the questions rather than the answers that are going to give you the insights.
Yeah. All right, let's raise some more questions. I think on the next slide, right, when we go into some topics that are specific to SMEs, right? And we can't always give answers, right? But we can point you, the audience here in the right direction of the questions you should ask yourselves when you do evaluation. I'll just start from the top, or Steve, how should we just pick points that are interesting?
Pick some points. So you pick some, and then hand over to me, and I'll see whether there's anything left.
Okay, well, I'll let you go first then.
All right. Well, key person risk, for example. I mean, you've got to look to see what that person's doing, how you can replace him. I think statistically, it tends to reduce value by anything between 4 and 9%. There's been some research on this, but the idea is that if someone is not replaceable, you probably don't have a business to sell. Because that person would then have to come with the business, and a lot of the time, if someone wants to sell a business, that's because they want to go off and do other things. So a bit like the intangibles in that way is that some of these intangibles might not be transferable because they might be embedded in individuals, or they might go away. We're going to perhaps talk about this a little bit later, but they might not be accessible by a buyer. So this is the idea, and then another thing I'd like to do is the sort of the long-term plans. A lot of SMEs don't really have many plans past 2 or 3 years, and this brings me to the main point. There is that a lot of investors, of course, will be using the SME to buying it for lots of different reasons. Some of which might be the existing business, but others might be options that existing business gives to their own business. And so a lot of the forecasts might actually be irrelevant to most buyers.
Yeah.
They're relevant because they will determine at what points that the seller walks away from the transaction, you know, as a negotiating position, but not necessarily from a purchaser's point of view, because they're going to do their own thing with it.
Yeah, yeah. I mean, I see that a lot, right? Also, I saw that a lot in my M&A practice, right? I mean, you know, you obviously you have a look at whatever the seller sends you, right? But you always build your own model, right? And that's more, you know, more driven by, you know, who can I sell this to, right? In the case of buying smaller companies, what can my sales force do with this, right? Do I have revenue synergies? Do I have cost synergies, right? And other synergies, and what can we do with that asset? A very, very good point. Yeah, yeah.
You
But
mentioned
also,
cost synergies. Sorry, you mentioned cost synergies, but they're yeah, obviously that's the normalization of the transaction, and the normalization of the cash flows in that way. And that's why when you have professional services firms, we often use a multiple of fee income, don't we? Because we can control the what comes down below the fee income, because when you buy it, not necessarily with other firms, of course.
Yeah. But of course, those assets, right? If it's the fee generating people, if they can walk out the door, then we're you know, we're coming back to the point you raised earlier, right? Key persons and so on, right? So what's the going multiple now for a professional services firm? I'm curious.
Anything between 1 and 2.5 times,
right.
2.5 times. Though you get these golf course valuations where the the managing director has a golf match with his friend, and his friend sort of sows the seeds like five times fee income or something like that, you know. And you have to be a little careful with that, because that has to be exploded sometimes. But you know, like everything else, it depends.
Yeah. I mean, it's interesting on the private equity side. We see a lot of situations now, you know, roll-up strategies of, you know, insurance brokerages, you know, tax advisors, audit firms, accounting firms, where that is highly relevant, right? And yeah, we typically see, like, you know, one-time annual fees as a sort of lower end, but then also, you know, IT services, right? Cloud migration services, you know, 2.5 times, right? Like you mentioned, right? So
yes, and, you know, and you look at those, for example, they're all about cost, you know, stripping costs out, because you know, any roll-up strategy is basically going to work on the cost side. It may be with some extra branding, of course, which will help on the sales side, but, you know, primarily your low-hanging fruit is going to come from the cost side.
Very true. Okay, so I get to pick now. I'm going to pick point number 3: non-market usual transactions, limited arm's length, and we worded that in a bit unusual way. But essentially, what we're talking about is here, you know, the company uses, I don't know, the property or the building of the owner, right, and it doesn't pay rent for it, right? Or I don't know, the significant other half is employed at either a very high salary or a very low salary. Well, it can go both ways. Or, you know, the family, and that we have another point on this, right? That's third to last, employing close relatives, and la familia, right? So that can create tricky situations, right? And in my experience, that's a big driver, right? That can lead to very, very different outcomes in evaluation if you don't adjust for that, right? So what you always want to do is you want to basically, you know, not use actual numbers, but, you know, adjust that so it would be an arm's length transaction, right? You would include some sort of calculatory rent, right, for a building, or you would, you know, calculatory salaries. Do you call it that in English, by the way? That's how we call it in German.
Well, normalized salaries. But, you know, it goes both ways, because you can have a situation where you might want to replace an old chap like me with someone more performing and cheaper. But you can also have a situation that I had with a primary school, which had been set up by a Scottish couple in Belgium. When that primary school was purchased, they needed 5 full-time equivalents to replace them. Because they'd worked 24/7, they knew the business perfectly, and, you know, it was their baby. So it works both ways there with employment contracts.
So I guess don't just take earnings numbers or even revenue numbers at face value, right? They might be very different under different ownership, right?
And we'll come on to how that links into different observed multiples as well, perhaps a bit later on, because there can be quite a lot of distortion of observed multiples on small company transactions.
I'm going to pick another point because it's related to what I just said, and I already touched on it. Differentiation of company assets and private assets often not entirely clear, right? It can be, like we mentioned, land or buildings that are used by the company. It can be things such as patents, right? That a company doesn't pay for because it's owned by the owner, but it would otherwise have to pay royalties, right? It can be things such as guarantees, even, right? An owner guarantees a loan with his private, wealth, right? And in a different, so they maybe don't pay market rates for that loan, right? But they would otherwise have to pay market rates, right? Yeah. Those are some examples that come to my mind. I don't know if you can think of anything else.
You find this a lot in forensic situations, especially when you have conflicts between two partners, and the idea is, well, how much is the total return on a business? And it's not only what you're getting in the business, but also things like guarantees on the other side, but you may be getting benefits from the business, which you wouldn't normally get if you didn't own the business. Private benefit of control.
Yep. Okay, do you want to go next again? Yeah.
Well, I'll choose non-standard financing structures. Again, these loans, preference shares can be guaranteed done a different way. Directors' accounts is often used as, is it equity, is it debt? Again, it's something just balances. And generally, I find that owner-managed businesses and SMEs are suspicious of debt. I have this theory that a lot of us who go on out by themselves actually originally did it because they didn't want to be told what to do by idiots. And I'm not saying that in the company you work for, but banks sometimes come under that category, especially if you're a little bit, let's say, skeptical of banking practices. So there can often be no debt at all. But again, of course, this would have to be brought in if you're valuing it on an arm's length basis.
So would you just use a sort of a normalized capital structure, right, when you calculate your cost of capital?
Yes, I would. Yes,
yeah.
And going forward, and if that cost of capital is going to change throughout the period, you go straight to the terminal period, because of course in a DCF the terminal period is driving perhaps 80 or 90% of the value. So if you get that right, it doesn't matter what happens in to the cost of capital in the explicit forecast period.
Yeah. Okay, my turn again. I choose management compensation and payouts often not completely separable, right? An owner might, pay him or herself a very low salary, right? But a relatively large dividend, right? And so that company would clearly overstate earnings, right? It would look a lot more profitable than it otherwise would be, right? Something we see a lot different. I mean, obviously it depends on the tax laws in different countries, right? You mentioned earlier when we talked about it, Belgium, right? Even when it comes to transactions. But that's definitely something that should be analyzed carefully.
Do you want me to expand on that?
Oh yeah, please. Yeah.
Well, I lived in Belgium for many years, and at that time the profits on share transfers were not taxable. And so what would happen is people would stuff everything into the purchase consideration, including the next 10 years service level contract and employment contract. And so you'd have an inflated purchase consideration, which was not taxable. And then on the other side, people would be reporting very, very low taxable income. So you'd end up with if you looked at some comparable multiples on transactions, you'd find some incredibly high multiples. But that was because the numerator was overstated and the denominator was understated. And so you have to be a little careful. You almost have to normalize these transactions if you're going to use them.
Or even it doesn't even have to be a transaction, right? I mean, even just paying out dividends, right? And in some in some countries, personal income tax is 55%, right? But if you pay it out via a dividend, right, it's 25, 75, 5.5%, right? So they can make a big difference.
Yeah, absolutely.
Anything that we haven't mentioned yet?
No, I think we can probably move on. Yeah, that's
most
important. We've beaten these to death, I think.
Yeah, I will probably come back to some of these points again later on. Yeah, important factors. I mean, a lot of this is, I think, it overlaps with what we saw on the the previous slide. Some new ideas here too. I mean, you mentioned a very interesting one earlier, the dog and cat goodwill point. Do you want to expand on that?
Well, when anything's invested in individuals, they can sell a business, and even if you've got a non-compete clause in there, very, very difficult to enforce a lot of the time. And so what we talk about dog goodwill, the dog goes with its master. If you move house, the cat prefers to stay at the old house, which is the sort of goodwill you want. You want it staying with the house that you've bought rather than going off with its master. And as soon as certain people leave, then you may very well lose all the goodwill because it's embedded. And it comes back to intangibles as well. Your intangibles have to be able to control them. And with embedded intangibles, it's very, very difficult. Well, first of all, to establish ownership, but also to control them. And without intangibles, why would you do an acquisition? Why not just buy assets or hire somebody? And that's again, people often say, well, I want to buy something. You can buy something, but you don't need to buy a business. You can buy the assets and hire some people. And if it doesn't cost you too much in time to market, it might be a better way to go.
That reminds me something of one of my very first corporate finance courses, by the way. I mean, I worked in investment banking before, and I remember the professor said, never buy an investment bank, right? Because it's the it's the people that make it work, right? It's fee income, and they can just walk out the door, right? And I was reminded of that this year, right? Because there's a new wave now of acquisitions of investment banks in the UK too, by the way. So I felt, oh, it rarely goes right. No, it rarely works. Right?
No, very difficult. Also, professional services mergers are very tricky as well.
Yeah. Okay, I'm gonna pick limited buyer universe, right? Private companies, smaller companies, sometimes very specialized, right? So there might, and then also regional very often, right? If you're talking very small, right? The corner shop, the bakery, the hairdresser salon, who's going to buy it, right? There's no international market, right, for a grocery shop on the corner, right? So even though your valuation might produce a fantastic number, doesn't mean that you will find the buyer, right, for that business.
No, so you're limited in the market, but also I would say use the word disparate, which means they're not desperate, disparate. Where people are, people might buy this business for very different reasons, and so the buyer universe might actually be if you're lucky, they have 4 or 5 buyers. They might all be wanting to use it for a totally different reason, and it's difficult. And to get fair value, all you get is some sort of negotiating platform, if you like.
Yeah. Any other ones we should pick? I think your turn again.
Well, reporting quality is one.
I wanted to pick that too.
You want to pick that as well? We'll do a double handle on that. Of course, smaller businesses will always understate their earnings. Unlike a larger business who wants to impress their investors, a smaller business does not want to. The only person they're going to impress by reporting high earnings is the tax man. Probably this guy's not at the top of his Christmas card list. So there's a general sort of any decision you can make to reduce earnings, and that's where I think the benchmarking. Something I do like about Valutico actually is well, there's quite a lot of things I like, but is the benchmarking different companies to find out what the normalized margins might be for businesses which are not quite subject to the same. I'll call it tax gymnastics to be. To be neutral here. So reporting quality can be, and it's not because there are bad systems. It's just that there's no real incentive to report very high amounts.
But there is also the other aspect, right? It doesn't even have to be intentional. It can also just be lower quality, right? Reporting, because there's no CFO, right? There's no finance team, right? So it's maybe just somebody.
Well, let me take a couple of examples there. If they've issued share options, for example, you're unlikely to have good reporting for that, because a lot of the time the share options will be valued at 0. Therefore, there'll be no expense coming through under IFRS 2. They've agreed this with the tax authorities. The tax authorities have waved it through, perhaps. And so as a result, you're understating your personnel cost. You may also be overstating your production and fixed asset cost, because you often find this element called what we call gold-plated engineering, which used to be talked about with Mercedes. It was too high a specification, And so there's lots of different things which it's not the quality, but also the quality of earnings, I would say, is the situation there.
Yeah, yeah, very important point. Okay, if we cover that one, I'll pick, and we talked about it, but here it's formulated in a nice way. Buyer situation. The alternative can be to just build a new, right? You know, if I buy I don't know, an existing manufacturing company, I might as well buy all the machines, right? And a big factory hall somewhere, and hire some people to do it, right? Or in the German-speaking markets, one of the cases that is always used is that of, say, a doctor's office or a dental practice, right? You know, what I essentially buy is, you know, a client base, right? So the way we value things such as that is, what do I save from year to year, right? By not having to build that client base, right? Because, you know, I can buy all the machines, right? There's not much there in a dental office that is, you know, beyond those machines, right? And the dentist, right? So important consideration, right?
I agree, you know, and I think whenever you're doing any acquisition or any valuation, you've got to look to see what intangibles will be part of this. I do a lot of work with purchase price allocations, and I think you know, a lot of it's to do with financial reporting. But I also think it's very useful to say, well, rather than buying a business or buying some shares, I'm actually buying a portfolio of intangibles and, you know, fixed assets and working capital, of course, but intangibles. And of course, there's some goodwill there as well, which is where you can't find a home for the intangibles. But a lot of the time, the intangibles, there aren't many.
Steve, apologies to interrupt. So we have a question here. And the question is, how would you normalize SME net income when performing a valuation?
Well, do you want me to have a go with that, Paul, or do you? Oh,
go ahead. Yeah.
Well, you know, I would start looking at the benchmark comparable companies and see what percentages their profit margins and their overheads typically are. And you can see what a mature company would have and a larger company. Now, of course, an SME is not going to be quite that efficient because of questions of scale and scope. But it's going to give you some idea to normalize it. And then, of course, ask questions about the pressure points that we've just talked about, especially to do with salaries and the nature of expenses coming through, for example.
Yeah, normalize to a level where everything's basically at arm's length, right? All these things we talked about. Yeah. Even below, you know, the EBIT line, right? I mean, financing structure, taxes, everything, right?
Yeah. I don't know if that helps. Hopefully, that helps the person who asked that. But
otherwise, we're waiting for the follow-up question.
Yeah.
There was something I wanted to add because you mentioned something. Yeah. Oh, sorry. Yeah, you mentioned the benchmarking aspect, right? So Valutico already gives you a lot of options to benchmark against other companies, mostly public companies. But we have something very interesting in development right now, where we will also aggregate more and more benchmarking data from private companies. Something that was often asked for, yeah. Can't give you a date yet when we're launching, but that will be, I think, a game changer also when it comes to benchmarking.
Good.
Okay, anything else on this slide?
Well, I think we might move on a little bit because we think we've got to get a couple of things to go. Yes.
Yeah. Theoretical issues. Anything that we haven't talked about yet?
Well, you know, when you look at the market theories, some strong market theories that everything's baked into the any valuation. I think you're very careful with that because I don't think a lot of SMEs think in terms of value. They think in terms of putting money into the family bank account to start with, and it's as if the value creation is almost an afterthought here. Just looking at some of the elements here, risk. I mean, how do you work out a cost of capital for a small company? You know, I think that's where you're probably going to have a range because you know each small company is going to be very different from from the listed companies that you look at. So that's why we often use multiples. And again, you may take quite a few discounts from multiples as well for that. Just looking at some of these here, I think we've covered a lot of these, haven't we? You know, just one final thing is just because something's large and well organized doesn't mean it's more complex. I find that some SME valuations are much more complex than anything larger organizations can throw at you.
unfortunately not as well paid in most cases.
No.
For the same work or even more work.
I totally agree with that.
Okay, so before we hand over to Greg, maybe a quick summary of these points. Yeah, I'm trying to have a look. Maybe the last 2 points, again, I think everything else we already talked about. Last 2 points, because they're quite practical. I mean, choosing the right peers and transactions, even more important, right, for smaller companies, for SMEs, right? Transactions, I mean, we have 1 million transactions in the system, more than anyone else, but that's key, right? You need to find the right comparables. Yeah.
I had a question. The course I was teaching earlier this week was whether you should build up from the bottom or you should take as many as you can and then take off. Because the tax authorities often want you to take as big a group as you can and then eliminate. Whereas my feelings, I often sort of build up of ones which I really want to have in there. I don't know if you have any thoughts on that, Paul.
Never thought about that, to be honest. Don't do too many valuations for tax authorities, but I would usually start with a long list and then also eliminate, I think.
Yeah, I hadn't thought much about that either.
Yeah.
I would say, I mean, I think something we've talked about, do put as experienced people as you can on choosing the right peers, and because this is your basic information.
Yeah.
Don't choose someone who's just sort of come in from doing a degree in Latin and Greek, which is what I did, and expect him to be or her to be able to, to do anything with choosing the right peers and transactions.
Right. In terms of percentages, like how would you split? What percentage would you dedicate to normalizing financials? Let's say, what percentage would you dedicate to choosing right peers and transactions, and all the rest? I don't know if we can answer that.
Yeah, I don't know. I mean, there's two. Given that there are two things which keep our audience awake, quite a lot.
Yeah.
I would say the right peers and transactions. Actually, it's not a lot of time. It's a lot of thinking power. So it's something you might be able to do in an hour, but you need an hour's good thought on it. Whereas normalizing earnings or normalizing EBITDA probably takes you a little bit more time. But choosing the right peers, I can probably sort that out in an hour, but it's an hour's heavy thinking, and with the CEO of the company or the CFO of the company in front of you as well. Asking the questions, because they're obviously going to be a very useful resource.
And they want to be involved, right? They want to understand the valuations. Yeah. By the way, I mean, I find Valutico super helpful with that, right? Because, you don't have to do any of the number crunching, right? You can do this in real time, right? And see what the effect is on your valuation.
I'm just laughing because I actually run through the qualitative assessment with my clients, and I have them in front of the screen in front of me. And I always, when it comes to management quality, I always rip it down to 0, and they go, "Oh no."
Yeah, always a great opener.
Sometimes the CFO agrees with me, but you watch out for that.
But for me, that's always the point where it's super high, and then the key man risk or key woman risk is also very high, and that sort of offsets each other, right? Okay, with that, totally lost track of time as usual when we speak, Steve. Greg, sorry we took up a bit more time, but I think that takes us to the case study.
Lovely, thank you so much, Paul. Really, really insightful. And I'll share my screen, and we can put this all in a practical context.
And Greg, maybe because we probably don't have time for a full Q&A session, I'd just encourage everyone to maybe just post in using the Q&A tool, and we should try to answer that in real time, live.
Sounds really good. Yeah, absolutely. So I'm going to give a demonstration of Valutico's platform. We're going to do a live valuation on a software firm. So when you log on to our platform, quite simply, you're presented with modules where you can value private companies, listed companies. We've got access to lots of key market metrics, useful valuation parameters. We build up a list of industry sectors. This tells you how many companies we have in the system. And across the top, you've got the key multiples, and hand in hand with that, we've got a transactions tab, which again shows you how many deals or transactional data we have in the system, along with the multiples. Naturally, once we go into the main system, we can take a more granular and closer inspection of both the peers and the transactions. So let's begin. The first thing we're going to do is give it a name. Obviously, we're going to use the UK. This is a global platform, of course. You can value companies in most jurisdictions. So we're going to choose software, as the industry sector. Here, even though we're looking at private company, we'd always encourage you to add a public or listed peer. Why? This will really help the platform better identify the product service line, the operating model, and it will also go a long way in helping to identify the relevant peers. However, if you can't immediately think of anything, no worries, you can leave that blank. Next up, you would select the data valuation. Today's date is always the default. However, for some of you, on occasion, you may do a backdated valuation. So a bit like jumping in a time machine, you go back to a certain day, and it's as the peers, the multiples and transactions were, of course, that time interval. However, I'm going to keep it for today. 2 final fields to complete. Would encourage you to enter the last actual year end. So I'm going to use calendar year end 2022. And last but not least, you can enter the revenue figure, which I think for this example was 4 million sterling, and naturally you can choose your appropriate currency as well. So that's all we really need, and away we go. The first stage in the process for us, which the gents touched on earlier, is our qualitative risk assessment. This has specifically been developed, of course, for SME valuations. On the left-hand side of the screen, you can see where we are in the process. So I think most of you probably do something quite similar, a bit of a scoping exercise. So what are we trying to achieve? We're trying to uncover some risk factors in order to work out our cost of equity premium and our discount to the trading multiple. So go down the list, grading, assessing company size, positioning, market share, competition. Everything, of course, loads and it's average or equal. So this is where the human touch comes in. Management quality, I had a bit of a joke a little bit earlier on. That should encourage you to put it as high as possible, particularly if you're doing this with your clients. And as you've probably noticed at the bottom, the risk, the premium, and discount, they will decrease. So very quick introduction really to this section. On the right hand side, you've got the weighting system, order of magnitude importance. You can obviously change these as long as they stack up to 100%. Once you do finish this exercise, of course, you can manually override the premium and liquidity discount. We appreciate people have strong thoughts, feelings, and sentiments about those. Quick look at our ESG module. I won't spend too much time on this, but as Paul mentioned, we've developed a questionnaire. Naturally, this is another optional stage. You wouldn't necessarily engage this on each and every valuation you do. However, let's say you're valuing a business in the manufacturing space, natural resources, or another business which has a bit of a focus on sustainability. You'd either answer the questions on behalf of the client, or sometimes you may prefer to send a questionnaire directly to the client, and then that's where the ESG score is produced, which will have an impact on the cost of capital, allocation, and the discount rate. If anybody would like further information on our thinking around ESG when it comes to valuations, then please drop me a line after the session. Happy to share some more information. Back to the main, the next section for us on the platform is the peer selection. So what the system will do will generate a list of comparable peers. This is just a starting point, of course. This is not the finished list, complete list, or the perfect list. Again, some human intervention is expected. You're the consummate professionals, of course, so you look down the list, remove any peers which obviously are not applicable. You can also add additional peers, lots of nice filters, where you can do some quick fire searches and see what else is available on the platform. And then a fresh list, obviously, of peers is produced. And if any of these peers appeal, you can obviously add them to the equation. Quick cheat or hack here really is the way I personally use the platform. I head straight to the full text search, enter a product service line, much easier, much quicker to find exactly what you're looking for. Across the top, hopefully these need no introduction. You've got the different methods, EV sales, EBIT, price earnings, the financing structure, equity ratio, credit spread, R2 squared, and the levered beta. Got a benchmarking tab here at the top, so you can quickly compare sales growth and average EBITDA margin. And of course, as you would expect, you can really drill down into these organizations and take a closer look at a profile. As a reminder, we've got over 53,000 companies, all come with a write-up description, product service line, website. We also supply with the financials with our partnership with S&P Capital IQ. This is all lifetime. So we've got the income statement, capitalization, the valuation multiples, the balance sheet, capital structure, debt, credit spread, and the betas. Also, we show you similar peers as well. So you can have one more quick cursory sweep of the system to ensure you haven't missed anything. So that's the peer selection. Next up for us, the business plan, the financials, all about the numbers, of course. So here you'd have the opportunity to upload your own existing models that you've successfully built up over the years. You obtain the projected numbers from the clients. In terms of the color coding here, anything in blue is a manual input, anything in green, these are actually the consensus analysts forecasts, which we also provide you with. You can rein in the forecasted period. Most of my clients typically forecast out 3 to 5 years out. Historically, you can upload 5 years with numbers. Just some tabs to quickly show you at the top. Here we have a validation tab. This is a bit of a plausibility check, just to ensure that the business plan is internally consistent. So you can see the growth rates, the margins, investments, including reinvestment rates, value drive analysis, which focuses on assets and return on capital employed. Lots of benchmarking tabs as well, so you can compare, contrast sales growth, EBITDA, EBIT, net income, CapEx, and other. Also, we give you the opportunity to include net debt bridge, where you pop in the company's debt, pensions, cash obligations. You can even add your own custom net debt line item. Just finally, in case you're wondering, the platform recognizes Excel. So here I have a bog standard business plan in Excel. We simply create a separate export tab where on the left hand side you've got the financials, you've got the numbers at the top, and that way the platform recognizes the numbers. Finally, we've got Scenario Manager here, where of course many of you, I'm sure when you're performing valuations, you're not coming up with just the one end outcome, making the assumption you're probably preparing the base case, top case, worst case, which of course allows you to upload more aggressive numbers, more conservative numbers, and so a little bit more realistic. Next up for us, moving towards the business end of play, is our transaction selection. This is where we house all of our private company data. As you can clearly see, a list of deals are presented. Again, quite similar to the peer section. You're also responsible for the vetting, refining, removing any transactions that you don't like. I think an earlier question that we had, can you use your data or your own transactional data? Absolutely. We give you the option, many of you of which are probably already maybe subscribing to multiple market data providers, maybe one. So we give you that opportunity. Anything you do choose to include of your own, so a peer, a transaction, a financial statement, that obviously stays strictly within the confines of your account. Just to finish off here, very comprehensive filter. So you can do a search by industry, country, countries, region, the world, of course. You can do a search by date, deal value, stake acquired, bidding company, tile company, full text search. Again, as you would expect, you can review the details of some of these transactions. Some of them are fairly descriptive. You can also do a search by same buyer. It's quite useful, of course. You can see what these guys have been up to as far as the acquisition spree is concerned. And my personal favorite, there's one particular transaction which is bang on the money. You can ask to see similar transactions, okay? So that's pretty much the transaction tab. Next up is the end game, is the end valuation report. We present the results in a football pitch style presentation. By the way, we're showing off here, we're showing you all of the methods in one go. Naturally, we wouldn't expect you to use all of these. As a reminder, we called this one test company. Here we've got entity value, enterprise value. You can quickly flick to this switch and get equity value. The green dot represents the value of our business, of course, based on the specific methodology. The darker blue range is the range of the peers. The lighter blue range is the average of all of these. So this time, we did this super quick in the time we had with valuing this business between 6 million and almost 10 million. But two things, obviously, I've zipped through this. I only had about 10 minutes. So naturally, as the consummate professionals, I'm sure you'll spend a lot more time in each section. And then after that, we've got the net debt bridge. And of course, you can choose your different valuation methods. Most of my clients typically use 3 or 4. So I'd encourage you to switch off the others. And then all of a sudden that value range will narrow considerably. Yeah, the net debt bridge. Here also we show you the discount rates. Green is showing you cost of equity, blue cost of debt. In the middle, we've got the cost of equity premium. You're the master of your own ship here. So as you'd expect, you can interchange between the different business plans. You can override the valuation range, and anything you see, you can adjust. Everything, this is not a black box. Everything is source referenced, of course, as you expect. So you can have a definition explanation of where the information has come from. And if you change any of this, then obviously this will have an end impact on the valuation. And then after that, we're just showing you each valuation method in a lot more granular detail, along with the sensitivities, the WACC, the perpetual growth rate. But as you can see, a very comprehensive presentation has been produced in a matter of minutes rather than a number of hours or days. Of course, you can share this valuation. Many of you probably work within a team, so you can share that with a colleague. They take over the valuation. All the valuations are stored safely and securely in the system. As far as export capabilities are concerned, we can export in Word and PowerPoint, and also in multi-languages as well. So those are the current languages being supported as far as the output is concerned. Then just to show you the end game really is the end presentation, normal PowerPoint, but obviously you can upload your logo, you can choose your own corporate colors, font styling, give you a full and adequate explanation, but feel free to add your own narrative as well. But yeah, pretty comprehensive deck. One thing our clients do like to do, many of you of course already have some form of template which you trust has been approved. So let's not reinvent the wheel. Another option may be the possibility to actually upload your existing template to the system. And then we have a series of placeholders here. So all of the data points quite granularly provided, and then you can decide how your valuation report looks like. You can pick and choose the different fields. So as an example, if you took a shine to a qualitative assessment, you can copy and paste this placeholder page 4 or 5 your template, and that would instruct the platform where to drop or dump the data. So a little bit of a time investment, of course, going down the list, copy and pasting, but the good news is you only do this once, you name it, save it, and then it remains in the platform perpetuity. Final point to mention, should any of you decide to join us, and hopefully that's the case, we will provide you a very comprehensive onboarding training session where we'd encourage you to come to the session armed with your valuation you have to do, and you get somebody to look after you, show you how to utilize the platform to best effect, show you the functionality, and then you have one person looking after you after the training and onboarding finishes. So that's it. I think we've got 4 or 5 minutes left. I'll pass back to you, gents, for any questions and final thoughts.
Been busy answering some very good questions already on the Q&A tool.
Steve, any concluding comments from yourself?
Muted.
I think you're on mute, Steve, still.
Sorry, I was muted. Yeah, let me come back to the qualitative assessments. I think it's just so flexible, and you know, it sort of helps, especially the weightings as well. You didn't mention venture capital model, which is something which I find useful as well for startups. You know, it's a good pull methodology, which is very useful indeed.
Mm-hmm. Steve, have we activated our ESG module for you?
Yes, okay, I've had a look at that. As I said, we've you know, it gives you a slight bounce on the cost of capital, and again, you know, it's nice to feel that the good guys might actually win once or twice. Being surrounded as we are, as many people who are dumping externalities, especially in our country, in rivers and things like that. Yes, it's nice. It would be nice to think that the people who are actually doing things decently are going to get some sort of value out of it.
Yeah, agreed. I mean, it was also our goal, right? To build something so people look at the company value more holistically, right? Not just the financial value, but you know, the value of a company to society. Obviously, we have to translate it into financial terms in the end.
Yeah.
But there's some really interesting conversations that we have, right? Even people who were skeptical of ESG in the beginning, right? And I was too, right? Diverging goals and so on. You know, you can't serve many masters, I think is the saying. But even people who were skeptical see it as a sort of self-fulfilling prophecy, right? In private equity, in VC, meaning that if you don't do the work on the ESG side today, you will not be able to sell this asset in 5 years, right? Yeah. Because there won't be any buyers, right? So yeah, I hope it works this way, right?
Well, we're seeing a society is full of changing sensibilities at the moment, which is, and I think it's best to be prepared. And I think that's what ESG helps us with, you know.
Yeah. Very good. Just in time. Steve, absolute pleasure as usual. Thank you very much.
As always, Paul.
Greg, thank you for a fantastic demo. And
thank you,
thank you everyone for tuning in today. And if you have any more questions, feel free to get in touch with us. You have Greg's contacts, I think. And yeah, we look forward to hearing from you.
Thank you much, everybody.
Thank
you. Have a good day. Bye-bye.
Bye.